This week on the Retirement Quick Tips podcast, I'm recapping the economic and market conditions that are impacting you and your retirement nest egg this year. Today, I'm talking about the mixed signals in the markets and the economy. Down is up is down. I've been so confused about the direction of where the markets are headed, where the economy is headed, basically since the pandemic. We have a slow growing economy. And that's basically the way it's been for the last several years. On top of that, we have really high interest rates. Like if you told me 3-4 years ago that we would have, basically in 2020, 2021, that we'd have higher inflation, then the Fed would have to step in, aggressively raise interest rates, and then they'd stay high for like 3 years, and that didn't send us into a recession, I'd be like, you crazy, no way. But yet here we are. I'm still waiting on that recession due to the higher interest rates and inflation and all that, and still waiting. We also have this insane housing market. Very few people are selling, even less seem to be buying. And then, of course, we have tariffs, which I talked at length about yesterday. That's the number one driver for the economy and the markets right now. The other thing that continuously sort of bothers me, and I wait for the next shoe to drop here, is the average American does not seem to be doing too well. We have student loan repayments that have restarted. We have very high cost of housing, whether you're renting or buying, high cost of everything. Many Americans are overstretched financially, and that's starting to show and has been for a while now. So I talked about this recently on the podcast, the buy now, pay later apps. If you buy anything online, look for the option to split it into 4 payments. I mean, you could do it with like a block of cheese even. It's like ridiculous. Yes, the $7 I'm going to pay for this giant block of cheese, please, by all means, spread that into 4 payments because I can't afford the $7. And you're seeing that. You're seeing people use buy now, pay later apps with grocery purchases, with food delivery. People are door dashing and then splitting that into 4 payments. You're seeing higher delinquencies on everything from credit cards to car loans. So for most Americans, I'd say at least half of Americans, maybe closer to like 2/3 of Americans, they have this house of cards that's filled with debt, and that can stand as long as the unemployment rate remains low. As long as you keep your job, you're not going to start defaulting on everything. Now, you're not going to get ahead. You're not going to be able to save and invest and do the things for the long term, but you're going to put off a financial crisis for yourself personally, a bankruptcy, as long as you keep your job. Now, the good news is the unemployment rate is still very low, and it really hasn't changed much over the last year. I know you see headlines occasionally of like big layoffs, but it seems unlikely that unemployment is going to change in a big way. There's a lot of reasons for that. Companies have been desperately trying to hire people and haven't found enough people for like the last 10 years. This is pre-pandemic. I've experienced this myself where, in the entire time that I've been making hiring decisions, which is basically over 10 years now, really hard to find good quality, qualified people. And I think that's pretty true across the board, at least in the business owners I talk to. I think unemployment is unlikely to tick up. I don't think you're going to see massive layoffs. Somewhere in the 4 to 5% range is probably where the unemployment rate will end up. It's slightly above 4% right now, which is pretty good. That's very low by historical norms. But in this sort of slow growth, higher tariff scenario, 4 to 5% is probably where it stays. And people who are laid off, though, they have a harder time finding a new job because while it shouldn't cause massive layoffs, the tariffs are going to cause businesses to pause. They are already doing this. They're taking a wait and see approach. They're not going to hire a bunch of people. They're not going to make big investments until the tariff situation becomes clearer. That will happen over the next several months, but I just don't see widespread layoffs across multiple sectors of the economy. Now, there's going to be exceptions here and there. Certain industries that are more affected by tariffs than others. You're going to see that. But I think you're going to see what we've already seen is a continuation of just a slowdown in spending of American consumers. Americans have blown through all of their excess savings following the pandemic. Higher prices are really starting to make them, like I said, overstretched. And we're starting to see that more and more companies, as they report earnings, are talking about, consumers aren't spending as much and that's hurting our revenue. And that's true across the board. But it's just not enough to tip the scale into a recession. Partly because of that is, counterbalancing the negatives, we have the extension of the lower taxes from the recently passed Big Beautiful Bill. That should help provide more certainty for businesses and should help boost near-term growth and offsetting some of the uncertainty that comes with the tariffs. We also have deregulation. Trump is a big deregulator, and so that's also expected to continue and should provide a boost to businesses as well. And lastly, we have some possible interest rate cuts, probably one this year. That seems like the most likely base case scenario right now. And then as long as the tariffs don't lead to a big spike in prices and inflation, may see that continue into next year. But again, that's all dependent on tariffs and what their inflationary impact is, because the Fed cannot lower interest rates if inflation is going to tick up. So that's a big unknown. But if the Fed is able to start lowering rates this year and into next year without spiking inflation, that will be a huge growth driver and unlock a lot of new investment in everything from businesses to housing. So what do we do with all these mixed signals? Like, what does that mean for you? In short, I think it means volatility. I would expect stock market especially, to remain volatile for the remainder of the year because the market's going to have to digest things that it's not expecting. And the one thing that markets don't like, especially the stock market, is uncertainty. It can deal with the bad stuff. It certainly likes the good news, but the uncertainty is what causes volatility the most. So I think we'll see elevated volatility, a lot of ups and downs in the market, more so than in a typical year. We've already seen it so far this year because of tariffs, and I think we're just going to continue to see that throughout the rest of the year. So I think the things that could send the stock market lower would be some outside unexpected shock. I don't mean like the Israel-Iran situation or, you look at outside geopolitical events, unless they are impacting the US in a big way, most of these world events that you hear about in the news, it doesn't even register as far as how it impacts the market. So keep that in mind. It'd have to be a pretty bad unexpected shock. Obviously, higher tariffs, especially if they're higher than what they're expected to be going forward. And then a further pause on interest rate cuts that's not expected. Like the Fed doesn't cut rates this year at all, and they don't cut rates, in the first half of next year. Like as long as that gets pushed out further, I think that could send markets lower as well. So I think we'll look back on 2025 and we'll see probably some forward progress in the markets. Like I think a sort of a base case scenario from here on out, you have some growth in your portfolio this year, but it came with a price of a lot of volatility that made you seasick. All right, that's it for today. Thank you for listening. My name is Ashley Michike, and this is the Retirement Quick Tips Podcast.